Good morning. This is Jeff Seaman, Vice President of Investor Relations. Thank you for listening to General Mills' prepared remarks for our fiscal 2023 fourth quarter and full year earnings. Later this morning, we will hold a separate live question and answer session on today's results, which you can hear via webcast on our Investor Relations website. Joining me for this morning's presentation are Jeff Harmening, our Chairman and CEO, and Kofi Bruce, our CFO. Before I hand things over to them, let me first touch on a few items. On our website, you will find our press release that posted this morning, along with a copy of the presentation and a transcript of these remarks. Please note that today's remarks include forward-looking statements that are based on management's current views and assumptions. The second slide in today's presentation lists several factors that could cause our future results to be different than our current estimates. And with that, I'll turn it over to Jeff.
Thank you, Jeff, and good morning, everyone. Let me start by summarizing today's key messages. Fiscal 2023 was a tremendous year for General Mills, marking the fifth consecutive year that we've delivered results that met or exceeded our targets for top and bottom line growth. We generated double-digit growth on organic net sales and adjusted EPS and exceeded $20 billion in annual net sales for the first time in our company's history. Led by our Accelerate strategy, our team successfully navigated an extraordinarily dynamic operating environment with agility, focus, and resilience. As we turn to fiscal 24, we'll lean on those same traits to continue to succeed as the business landscape evolves. We'll focus on continuing to compete effectively, driving efficiency in our operations, and maintaining our disciplined approach to capital allocation. By doing so, we expect to deliver financial performance in fiscal 24 that meets or exceeds each of our long-term growth targets. To underscore our commitment to driving strong returns to General Mills shareholders, our board approved a 9% dividend increase effective with the August 2023 payment. Slide 5 summarizes our fourth quarter and full year financial performance for fiscal 2023. We delivered 5% organic net sales growth in Q4, despite a significant headwind from a reduction in retailer inventory in North America retail. Adjusted operating profit was flat, and adjusted diluted EPS was up 1%, each in constant currency. These quarterly results were up against a challenging comparison from a year ago, when we delivered double-digit organic net sales growth and more than 20% growth in adjusted operating profit and adjusted diluted EPS. On a two-year compound growth basis, Q4 organic net sales were up 9%, adjusted operating profit was up 10% in constant currency, and adjusted diluted EPS was up 11% in constant currency. For the full year, we generated 10% organic net sales growth, 8% growth in constant currency adjusted operating profit, and 10% growth in constant currency adjusted diluted EPS. A year ago, we laid out three priorities that would enable us to continue to drive our Accelerate strategy and deliver our financial commitments: continuing to compete effectively, continuing to invest for the future, and continuing to reshape our portfolio. Let me share a few examples of how we delivered on each of these priorities in fiscal 2023. We continue to compete effectively in fiscal 2023, holding or gaining share in 53% of our priority businesses globally, when adjusting for an unusual competitive dynamic in cereal last year and looking at the platform on a two-year basis. This included share gains across many important platforms such as cereal, refrigerated dough, fruit snacks, hot snacks, soup, and seasonings. This marks 5 consecutive years of strong market share performance across our portfolio, enabled by our superior brand building, innovation, and execution, and supported with healthy levels of investment. We continue to invest for the future in fiscal 23 on many fronts. We increased our media investment by 17%, with a particular focus on digital consumer engagement. In fact, our media spend in fiscal 23 was 35% higher than our pre-pandemic level. We increased our total capability investment in fiscal 23, including a double-digit increase in our digital and technology investment. We also increased our investment in growth capital by double digits, supporting additional capacity on constrained platforms, including fruit snacks, pet food, and hot snacks. Another important way we invest for the future is by standing for good. We recently released our 53rd annual Global Responsibility Report. In this report, we share progress against our ESG commitments, including our commitment to reduce greenhouse gas emissions by 30% by 2030 and achieve net zero emissions by 2050. We've already made great progress on reducing Scope 1 and 2 emissions, with our 2022 emissions down 49% from our 2020 baseline. We achieved this through a comprehensive action plan, including implementing renewable electricity for nearly 90% of our global facilities needs and driving waste reduction at the plant level. At the same time, we still have significant work to do to reduce our Scope 3 emissions, most of which is either upstream within agriculture or downstream at our consumers. Because these areas are outside of our direct control, we're partnering with suppliers, farmers, NGOs, government agencies, and other manufacturers to make a bigger impact. To ensure we achieve our 2030 and 2050 targets, we've developed a glide path focused on key levers that will drive Scope 3 emissions reductions, including expansion of regenerative agriculture, dairy management, deforestation mitigation, logistics optimization, and supplier engagement. We are proud of the work we've completed to date, while acknowledging the challenges we face and the significant work ahead of us to achieve these important goals. We also delivered against our third priority in fiscal 23. We continued to reshape our portfolio, closing on 1 acquisition and 2 divestitures that further improved our growth profile. Including these transactions, we have reshaped more than 20% of our portfolio since fiscal 2018 and increased our net sales growth exposure by more than a full point. We believe that holding share across our current mix of categories and geographies will generate organic net sales growth that is squarely in the middle of our 2 to 3% long-term target. Looking ahead to fiscal 2024, we see a new environment emerging across multiple vectors. We see inflation moderating significantly in the coming year, going from 13% input cost inflation in fiscal 23 to 5% in fiscal 24. While certain commodity spot prices are down from their highs, we continue to see labor as the main source of ongoing inflation, showing up in our suppliers' conversion costs, at our co-packers' facilities, in our own plants, and downstream in our warehousing and logistics network. Our consumers have remained resilient, due in part to average bank account balances, credit card debt, and unemployment levels that are more favorable than they were before the pandemic. Despite that, we know from spending time with consumers that they are increasingly cautious about their financial future. This caution could have an impact on their at-home versus away-from-home food choices, the channels they shop, and the brands they choose, making it even more important for us to continue to invest in our remarkable products, innovation, and marketing that keep our brands relevant for consumers. And in terms of supply chain, we are emerging from a highly disrupted environment into one that is showing signs of stabilization. The current level of supply chain disruptions is generally in line with pre-pandemic levels, and our customer service levels have reached the low 90% range in the U.S., with the main barrier to reaching the upper 90s being various growth platforms where we have capacity constraints such as fruit snacks, cereal, and hot snacks. A more normalized supply chain environment will allow us to ramp up holistic margin management productivity savings, further reduce the cost of disruptions, and free up resources to focus on demand-driving activities such as distribution, innovation, marketing, and quality merchandising. Our ability to adapt has been a key differentiator for General Mills in the recent years, and we'd like our chances to continue to respond more quickly and successfully than our competition to whatever changes come our way in the year ahead. We established 3 priorities for fiscal 2024, highlighted on slide 12, with this evolving environment in mind. First, we will continue to compete effectively by leveraging remarkable brand building, innovation, and advantage capabilities to win with the changing consumer. Second, we will further improve our supply chain efficiency with a focus on increasing HMM cost savings and reducing costs related to supply chain disruptions. And third, we will maintain our disciplined approach to capital allocation by investing in the business, delivering strong cash returns to shareholders, and maintaining our balance sheet flexibility for portfolio reshaping. Let me share some of the actions we're taking within each of these priorities in fiscal 2024. As we move into a potentially more challenging economic environment, it's critical that we step up our investment in brand building campaigns that keep our brands relevant for consumers. In fiscal 24, we'll support strong campaigns across our biggest brands that highlight the great taste, convenience, nutrition, and importantly, value of our products. For example, our Pillsbury brand's Fill, Roll, Bake campaign continues to inspire easy everyday dinner solutions for consumers. Blue Buffalo continues to communicate our ingredient superiority through our True Blue promise and reminds pet parents of the joy Blue Buffalo treats brings to their families. And Old El Paso's Make Some Noise campaign in Europe drives ritualization by encouraging consumers to turn Friday into Fajita Friday. We'll also continue to compete effectively by stepping up the impact of our innovation. Over the past 3 years, we've launched a healthy number of new items leading our categories. However, the challenging operating environment has meant we've had a more difficult time securing customer acceptance for that innovation. As the supply chain environment stabilizes, we see retailers becoming more receptive to our new products, and we expect innovation to be a larger contributor to net sales in fiscal 24. In North America retail, we're adding Lucky Charms and Cocoa Puffs to our highly successful Minis cereal platform, and we're rolling out a new Kit Kat cereal. We're launching a new savory line of Nature Valley Crunchy Bars with nuts as the first ingredient and only 2 grams of sugar. We're bringing luxury to the yogurt aisle with the debut of Haagen-Dazs Cultured Creme, a new line of indulgent fresh dairy snacks in 6 varieties made with the same high-quality ingredients that we use in the beloved super premium ice cream. We're leveraging our superior cookie dough technology to provide consumers the most convenient way to bake banana bread at home with our new refrigerated batter. And our new Stat Queso Crunch Kit brings this great-tasting family favorite to taco night in 3 easy steps. In our pet segment, we've launched Nudges on the Go, which leverages more convenient packaging to create a new usage occasion. And Blue Benabars, which offer a familiar snacking form with functional benefits for your furry family member. In North America food service, we're providing more tasty nutrition, including a reduced sugar version of Cocoa Puffs in a 2 equivalent grain format that meets K-12 school nutrition requirements. And in international, Haagen-Dazs Macaron ice cream is a unique collaboration with world-renowned pastry chef Pierre Hermé. We're launching this blend of chewy macaron shells in a creamy Haagen-Dazs ice cream across pint, mini cup, and stick formats. We'll also continue to compete effectively by executing with excellence both in-store and online. We'll leverage our strong innovation lineup, new price pack configurations, and improved customer service to strengthen our share of the physical shelf. We look to restore our levels of quality merchandising through compelling end aisle and freestanding displays on highly productive categories like cereal and snack bars, as well as seasonal offerings in soup and desserts. And we plan to continue to leverage our data and analytical capabilities to assess and improve our presence on the digital shelf. These tools and processes enabled us to grow our e-commerce retail sales by 24% in fiscal 23, and we plan to continue this momentum in fiscal 24. Our second priority in fiscal 2024 is to improve our supply chain efficiency as the environment normalizes. In fiscal 23, we chose to focus our resources on service and supply chain stability, leading to lower than historical HMM cost savings. A more stable supply chain in fiscal 24 will allow us to reorient these resources back to driving HMM, which should help us get our cost savings back to historical 4% of cost of goods sold level. In addition to benefiting from fewer supply chain disruptions, we'll step up our HMM delivery in fiscal 24 by opportunistically internalizing production volume to drive better fixed cost leverage, shifting back to original formulas for more expensive alternatives we used during the pandemic in response to ingredient shortages, optimizing our warehouse and logistics networks that were sub-optimized to service the business, and leveraging our new supply chain digitization capabilities to eliminate waste. Our final priority for fiscal 2024 is to maintain our disciplined approach to capital allocation. Our first call on cash is investing back into the business to drive organic growth. In fiscal 24, we plan to invest around 4% of net sales in capital expenditures with a focus on high ROI cost savings projects and capacity additions on constrained platforms. We are also committed to utilizing capital to fund strong and consistent dividend growth. As we announced today, our board of directors approved a 9% dividend increase effective with our August 1st payment. With our debt leverage at 2.7 times, we have the flexibility for strategic acquisitions that would further advance our portfolio shaping ambitions. and to the extent we're generating excess cash beyond those uses, we will return it to shareholders in the form of share repurchases. By competing effectively, driving efficiency in our operations, and maintaining our disciplined approach to capital allocation, we expect to drive financial results in fiscal 2024 that meet or exceed our long-term growth goals. Our specific targets are outlined on slide 18. We expect organic net sales to grow 3 to 4%. We expect adjusted operating profit and adjusted diluted EPS to each grow between 4 and 6% in constant currency. And we expect free cash flow conversion to be at least 95% of adjusted after-tax earnings. With that, let me turn it over to Kofi to go into more details on our fiscal 2023 results and fiscal 2024 outlook.
Thanks, Jeff, and hello, everyone. Our fourth quarter financial results are summarized on slide 20. Reported net sales of $5 billion were up 3%, and organic net sales grew 5% in the quarter, reflecting continued positive price mix, partially offset by lower pound volume. It's important to note that our shipments significantly lagged Nielsen-measured consumption in our North America retail segment this quarter, primarily reflecting a reduction in retailer inventory. This gap represented approximately 3 points of headwind to our total company net sales growth in the fourth quarter. Adjusted operating profit of $889 million essentially matched last year's result in constant currency, driven by higher input costs, higher SG&A expenses, including double-digit increase in media investment and lower volume offset by positive price mix. Adjusted diluted earnings per share totaled $1.12 in the quarter and were up 1% in constant currency. Slide 21 summarizes the components of our net sales growth in the quarter. We generated 11 points of positive organic price mix in Q4, while organic pound volume was down 6 points, including the retailer inventory headwind I mentioned earlier. Foreign exchange reduced net sales by 1 point, and the net impact of acquisitions and divestitures was also a 1 point headwind to our fourth quarter net sales. A review of our segment results begins on slide 22. For North America Retail, fourth quarter organic net sales were up 5%, while comparable Nielsen-measured retail sales were up 10%. Constant currency segment operating profit was up 2% in the quarter, driven by positive price mix, partially offset by higher input costs, lower volume, and higher SG&A expenses, including a double-digit increase in media investment. For the full year, organic net sales were up 12%, with mid-teens organic price mix partially offset by a 4-point headwind from lower organic pound volume. Our net sales performance lagged retail sales growth by about 2 points for the year in North America Retail. In fact, retail inventory reduction was a headwind in NAR for 6 of the past 8 quarters as retailers put a sharp focus on their balance sheets and managed their working capital. Based on our assessment of current retailer inventory levels, we do not expect a further significant reduction in fiscal 2024. Despite the retailer inventory headwind, we delivered strong and broad-based net sales growth across our NAR operating units in fiscal 2023, with U.S. Snacks up 13%, U.S. Meals and Baking Solutions up 10%, U.S. Morning Foods up 7%, and Canada up 8% in constant currency. We competed effectively in fiscal 2023 with 68% of our North America Retail priority businesses holding or growing share when adjusting for cereal on a 2-year basis. On the bottom line, full-year segment operating profit increased 18% in constant currency, driven primarily by positive price mix, partially offset by higher input costs, lower volume, and higher SG&A expenses, including a double-digit increase in media investment. Moving on to our pet segment results on slide 23, fourth quarter organic net sales increased 7%, resulting in double-digit organic net sales growth in the back half, in line with our guidance. As we communicated over the past 2 quarters, our key pet food platforms are in different phases of recovery from our earlier capacity and service challenges, with net sales in the quarter up double digits on dry pet food, up high single digits on pet treats, and down high single digits on wet pet food. Constant currency segment operating profit was up 18% in the quarter, driven by positive price mix, partially offset by higher SG&A expenses, including a double-digit increase in media investment and higher input costs. For the full year, Pet segment organic net sales increased 9%. We drove double-digit net sales growth on dry pet food and pet treats, while net sales for our wet pet food were flat to last year. On the bottom line, pet segment operating profit was down 5% in fiscal 23, driven primarily by higher input costs, higher SG&A expenses, including a double-digit increase in media investment and lower volume, partially offset by positive price mix. As we look ahead, we expect to drive pet operating profit growth a bit faster than organic net sales in fiscal 2024, supported by improved volume performance, lower disruption-related supply chain costs, and benefits from our SRM capability. North America Food Service segment results can be found on slide 24. Organic net sales grew 1% in the quarter, including a 2-point headwind from index pricing on bakery flour. On the bottom line, fourth quarter segment operating profit was down 10%, driven by higher input costs and higher SG&A expenses, partially offset by positive price mix and higher volume. For the full year, reported net sales grew 19%, including a 6-point tailwind from the TNT Crust acquisition. Organic net sales increased 13%, driven by positive price mix, including a 5-point benefit from index pricing on bakery flour. Segment operating profit increased 14%, driven by positive price mix and higher volume, partially offset by higher input costs and higher SG&A expenses. Turning to our international segment on slide 25. Fourth quarter organic net sales were up 6%, driven by growth in ice cream, Mexican food, and snack bars, partially offset by a decline in Wan Chai Ferry frozen meals in China, as that market shifted back toward more away-from-home dining. Fourth quarter segment operating profit declined 9% in constant currency, driven by higher input costs, lower volume, and higher SG&A expenses, partially offset by positive price mix. Full-year international organic net sales were up 4%, led by growth in Europe and Australia, Brazil, and our distributor markets, partially offset by a decline in China due to the ice cream recall and lower consumer mobility in the first half of the year. Full-year segment operating profit was down 25% in constant currency, driven by higher input costs and lower volume, including the impacts of yogurt and dough divestitures and the ice cream recall, partially offset by positive price mix and lower SG&A expenses. Slide 26 summarizes our joint venture results. Cereal Partners Worldwide net sales were up 8% in the fourth quarter and 4% for the year in constant currency, driven by positive price mix, partially offset by lower pound volume. Häagen-Dazs Japan net sales were flat in the fourth quarter and declined 5% for the full year, reflecting a comparison against strong new product performance a year ago. Full-year combined after-tax earnings from joint ventures totaled $81 million, compared to $112 million a year ago, driven primarily by higher input costs at CPW and Häagen-Dazs Japan and lower net sales at Häagen-Dazs Japan, partially offset by favorable CPW price mix. Despite the year-on-year decline, fiscal 2023 after-tax JV earnings were still up 13% versus pre-pandemic fiscal 2019 levels. Slide 27 summarizes other noteworthy Q4 income statement items. Adjusted unallocated corporate expenses increased $25 million in the quarter, primarily reflecting higher compensation and benefit expenses and capability investments this year. Net interest expense essentially matched year-ago levels. The adjusted effective tax rate was also essentially flat in the quarter at 19.1%. And average diluted shares outstanding in the quarter were down 2% to 598 million shares, reflecting our net share repurchase activity. Our full-year financial results are summarized on slide 28. Net sales of $20.1 billion were up 6%, including a 4-point headwind from net divestiture and acquisition activity and 1 point of unfavorable foreign exchange. Organic net sales increased 10%, driven by positive organic price mix, partially offset by lower organic pound volume. Adjusted operating profit of $3.5 billion increased 8% in constant currency, and adjusted diluted earnings per share of $4.30 were up 10% in constant currency. Now let's turn to our margin results on slide 29. We expanded our adjusted gross margin by 120 basis points in Q4 and for the full year, driven by positive price mix, partially offset by higher input costs and volume deleverage. Our full-year adjusted gross margin of 34.2% is only 20 basis points below fiscal 2019 levels, thanks to our significant work to implement timely SRM actions, generate HMM cost savings, and begin to eliminate costs related to supply chain disruptions. And we see room for further improvement as we look ahead. On the bottom line, fourth quarter adjusted operating profit margin was down 60 basis points to 17.7%. Full-year adjusted operating profit margin increased 30 basis points to 17.2%, driven by higher adjusted gross margin, partially offset by higher SG&A expenses as a percent of net sales. Turning to the balance sheet and cash flow on slide 30. While we drove strong growth in adjusted net earnings in fiscal 2023, our operating cash flow was down from $3.3 billion a year ago to $2.8 billion this year, driven primarily by changes in inventory and accounts payable. Capital investments totaled $690 million, or 3.4% of net sales, which was up from 3% of net sales a year ago, driven by increased investment in growth capital. We delivered free cash flow conversion of 80% adjusted after-tax earnings in fiscal 2023, and we reduced our leverage to 2.7 times net debt to adjusted EBITDA, even after stepping up our cash return to shareholders this year. You can see on slide 31 that we increased our total cash return to shareholders by 25% in fiscal 2023 to $2.5 billion. Our 6% annual dividend rate increase in fiscal 2023 was partially offset by a lower net share count, resulting in a 3% increase in total dividends paid to $1.3 billion. And we stepped up our full-year net share repurchase activity by more than 50% to roughly $1.2 billion. With strong net earnings growth in fiscal 2023 and plans for continued growth in fiscal 2024, our board of directors today announced a 9% dividend increase in our quarterly dividend rate to a 59-cent per share rate, effective with our August payment. General Mills has paid a dividend without interruption or reduction for each of the 95 years we have been a public company. On slide 32, we provide some key financial assumptions for fiscal 2024. On the top line, we expect contributions from organic price mix to decelerate, but remain positive in fiscal 2024, following a similar trend as the deceleration in input cost inflation that Jeff mentioned earlier. The majority of our fiscal 24 price mix will be carried over from SRM actions taken in the back half of fiscal 2023. We see three key drivers of improved organic pound volume performance in fiscal 2024 relative to the decline we posted in fiscal 2023. First, we expect less of a headwind from pricing as our price mix steps down significantly from fiscal 23 to fiscal 24. Second, a more stable supply chain should allow for much stronger commercial activity, including increased distribution, innovation, brand building investment, and quality merchandising. Third, we have added capacity on many constrained platforms, including fruit snacks, pet food, and hot snacks. Moving down the P&L, we're forecasting 5% input cost inflation on our cost of goods sold, driven primarily by labor inflation that continues to impact all aspects of our supply chain, including our raw material suppliers and co-packers, our manufacturing facilities, and our warehouse and logistics providers. As Jeff mentioned, we expect to step up our HMM cost savings to 4% of cost of goods sold, and we'll continue to invest in the future, primarily in the form of increased brand building and capability investments. And below operating profit, we expect net interest expense to increase by 30% to approximately $490 million, driven by two main factors. First, we have roughly $4 billion of debt that will be refinanced between the end of fiscal 2023 and fiscal 2024, with interest rates on the new debt generally 200 basis points higher than the debt that it's replacing. And second, we'll be impacted by higher rates on our floating rate debt, which makes up about 20% of our overall debt portfolio. Our adjusted effective tax rate is expected to be roughly in line with last year at a little more than 20%, and we anticipate reducing our average diluted shares outstanding by roughly 2%. Based on those assumptions, Slide 33 reiterates the fiscal 2024 outlook that Jeff shared earlier, with each of our targets at or ahead of our long-term algorithm. With that, let me now turn it back to Jeff for some closing remarks.
Thanks, Kofi. Let me close with a few thoughts. We delivered a highly successful year in fiscal 2023 by executing our Accelerate strategy amid a volatile and inflationary environment. Looking to the year ahead, we will continue to build on our momentum by competing effectively, improving the efficiency of our supply chain, and maintaining our capital discipline. Thank you for your time this morning. This concludes our prepared remarks. I invite you to listen to our live question and answer webcast, which will begin at 8 a.m. Central Time this morning and will be available for replay on our investor relations page at generalmills.com.
Greetings and welcome to the General Mills fourth quarter and full year fiscal 23 earnings Q&A webcast. During the presentation, all participants will be in a listen-only mode. Afterwards, we'll conduct a question and answer session. At that time, if you have a question, please press the 1 followed by the 4 on your telephone. If at any time during the conference you need to reach an operator, please press star 0. As a reminder, this conference is being recorded Wednesday, June 28, 2023. I would now like to turn the conference over to Jeff Siemon, Vice President, Investor Relations. Please go ahead.
Thank you, Malika, and good morning, everyone. Thank you so much for joining us today for our Q&A session on our fourth quarter and full year fiscal 23 results. I hope everyone had time this morning to review our press release, listen to our prepared remarks, and view our presentation materials, which were made available on our investor relations site. It's important to note that in our Q&A session, we may make forward-looking statements that are based on management's current views and assumptions. Please refer to this morning's press release for factors that could impact forward-looking statements and for reconciliations of non-GAAP information, which may be discussed on today's call. I'm here with Jeff Harmening, our Chairman and CEO, Kofi Bruce, our CFO, and John Nudi, Group President for our North America Retail segment. So let's go ahead and get to the first question. Malika, can you please get us started?
Certainly. Thank you. Ladies and gentlemen, as a reminder, once again, if you would like to register for a question, please press the 1 followed by the 4 on your telephone. You will hear a 3-tone prompt to acknowledge your request. If your question has been answered and you would like to withdraw your registration, please press the 1 followed by the 3. Once again, that is 1-4 to ask a question. Our first phone question is from the line of, John Baumgartner with Mizuho Securities. Please go ahead. Your line is now open.
Good morning. Thanks for the question.
Good morning, John.
Maybe just to start off, just big picture, Jeff, I wanted to come back to this transition you're speaking about in the environment in this new fiscal year. You know, last year you made some pretty material investments back into the business. And with those now in the base and conditions getting back to normalizing, how are you sort of, adapting and evolving those resources? I know there's a lot there. There's innovation, quality, promo, productivity. But how do we think about the next steps for growth and what a more offensive strategy looks like for Mills going forward?
Yeah, John, thanks for the question. I'm glad you took a half a step back. I mean, as you look at our last year, I think it's important to remember that we grew sales at 10%, operating profit at 8, and EPS at 10, while investing in the business, double-digit growth in marketing and double-digit growth in capabilities. And so, as we look ahead, and our guidance also reflects our continued investment in growth. If you look ahead, we're going to be on track on all of our metrics on sales and operating profit and EPS, and ahead of our long-term algorithm for dividend growth, which reflects the strong year we just had, as well as our confidence in the year ahead. And so, you're right, we've been investing for growth. We'll continue to invest for growth while we continue to drive higher levels of productivity, which you saw in our release, and while supply chain disruptions get less, which again allow us to drive gross margin, which creates a really good flywheel for growth. And so as you take a step back from last week's Nielsen data, or what happened this last quarter, we feel great about the year that was, and we feel confident about the year that's going to come up. And I think that confidence stems from the fact that we have been agile the last few years. And it's not an accident we've grown share in the majority of our categories each of the last 5 years. And it's been hard work and good marketing. And as we look at the growth ahead, one of the things we're excited about is that, the freeing up of supply chain and the normalization of supply chain gets us back to the kind of productivity we've been looking for. It gets us back to getting rid of some of the pandemic era costs. But more importantly, frees the rest of the organization up to get distribution, to drive the innovation. We've got really good new product innovation this coming year. And then finally, let's our marketers market. And we've got really good ideas. And so we feel good, and I appreciate the step back.
Great. Thanks, Jeff.
Thank you. Our next question is from the line of Ken Goldman with JP Morgan. Please go ahead. Your line is open now.
Thank you. And good morning. I just wanted to ask a little bit about the decline in retail inventory. I'm just curious if we can get a little bit of color on which of the categories that maybe, felt the biggest impact this particular quarter. And I guess also, it's certainly encouraging to hear that, the worst is over as you see it when it comes to this particular temporary headwind. But, I think for some of us on the outside, or at least me, it does feel like a little bit of a red flag, right? That maybe end user demand isn't quite as strong as what you had hoped. So, I appreciate that your customers are trying to get their inventories into a better place. And, we're just not necessarily hearing that from many of your packaged food peers. So I'm just curious, what gives you the confidence that it's not necessarily a General Mills specific dynamic that's happening there? Thank you.
Yeah, Ken, this is Jeff. Let me start out with kind of how I see this broadly, and then maybe John Nudi can provide some commentary specifically. But and look, I respect the fact that our inventory decline was a surprise to some, given our strong Nielsen trends, and we feel great about our movement trends. And we did have a 5-point headwind in this quarter, and we didn't see that coming when the quarter began. So that is true. What I'm pleased with is actually we were able to hit our guidance on profitability and exceed margins and EPS, despite the fact we had this big headwind. We don't see this as a General Mills specific trend, and we don't see this as something going forward. It truly is, a couple of our big customers were trying to get their inventories back to a good place, and which I understand. The carrying cost of inventory is higher, interest rates are up. They're trying to work their balance sheets, and so, in retrospect, perhaps it shouldn't have been a surprise, but it certainly was an order of magnitude. I don't see it as a red flag for us. And I don't see it actually as a red flag for the industry as well. But I want you to know that from my chair, is something that's kind of behind us, and it's not General Mills specific. But John, if you have any specifics you want to add.
Yeah, absolutely, Ken. So as Jeff mentioned, we did see a 5-point gap between Nielsen movement and RNS in the quarter. For the year, that was a 2-point gap, and it's not something that's new. We've seen this phenomenon for 6 of the last 8 quarters. So as Jeff mentioned, retailers are focused on inventory. One of the things they feel more confident about is being able to supply the business after all the supply disruptions in the last few years, and feel like they don't have to carry as much safety stock. In addition to that, obviously, the inventory is more expensive, so working capital is a focus as well. As we look at the absolute levels of inventory, they're some of the lowest levels we've seen on record. So again, we don't believe that we can go much lower. What we can focus on are the controllables, and that's making sure that we have good marketing and driver baselines and our merchandising, and we feel great about that. We feel really good about the movement of 10% in Q4. So again, we feel like this was a one-time headwind. We're not expecting to rebuild those inventories, but at the same time, we don't expect another leg down in fiscal 24.
Thanks. And if I can just ask a very quick follow-up for Jeff, the pet business had a little bit of ups and downs during this past year, a lot of which is sort of out of your control in terms of supply. Is it reasonable to expect that we'll see an acceleration in your organic growth this year, or is it still going to be held back for most of the year by some of the supply issues that you have that are, of course, temporary?
Yeah, we did have we had a rough start to the first half of the year. There's no question about that, and the primary driver of that was lack of capacity. What I feel very good about in our pet business is that we've rebounded and our service levels are back in the 90s. The pet team worked very hard to get there. It's more expensive than we would like because we have to go outside for external supply chain, but we've rebuilt our capacity, so that's not a concern going forward. What I also feel good about is we did what we said we're going to do. We said we're going to grow at double digits in the back half of the year, and we have done that. I would also say that our dry pet food business is getting better, and we thought that would be the first to recover, and it has. It's responded very well to advertising. Life Protection Formula, I think, was up more than 20% in the fourth quarter. Our treats business, we said would improve, but would follow that, and it has, and it actually grew in the fourth quarter, and there's much more to do on treats. We can now market that business, and we have full capacity. And then we said our wet pet food business would lag, and unfortunately, we were right about that too, and it did lag. And so, I think for our pet food business, I would characterize it, I feel good that we have improved, and there is more work yet to do. And so as we look at this coming year, our supply should not be an issue for us. It will come at a higher cost. So I still expect us to grow our sales and maybe our profit a touch ahead of sales, but a big improvement in profitability I wouldn't think would come until fiscal 25, when we can internalize all of our capacity.
Thank you.
Thank you. Our next question is from the line of Andrew Lazar with Barclays. Please go ahead. Your line is now open.
Great. Thanks. Good morning. In the prepared remarks, you mentioned that volume in fiscal 24 should be improved relative to the decline you saw in 23. Just to clarify, should we take that to mean volume is potentially still down year over year, but better than the minus 4% decline that we saw last fiscal year? And then if it is going to be a pricing-led organic top-line growth sort of year in fiscal 24, and I think most of it you said was from wraparound pricing from actions taken in the second half of 23, I guess, is there a possibility, and I'm just trying to think ahead here, that there's a period of time maybe where organic sales could even go negative for a bit later in the fiscal year until sort of volume catches up? Thanks so much.
Yeah, Andrew, I'll take it, and then Kofi, jump in if there's anything you want to add. Our expectation, again, we don't give specific volume guideline growth, but having said that, we said our top line will go 3 to 4%, and we'll have mid-single digit inflation, roughly 5%. And so we do see pricing this year. I'm confident that our pounds will be better in fiscal 24 than they were in fiscal 23, which is to say they'll certainly decline less. Whether they get to positive or not, we'll see. That's a really difficult thing to call, especially because of the mix factor involved. I give you, this last quarter in China, our sales grew really nicely, but our pounds were down. It's because we sold more expensive, Haagen-Dazs ice cream and less Wan Chai Fairy dumplings. The same could be true said of our food service business, where, we sold less flour and more of other things, so our pounds were down. So pounds is a little bit tricky because of mix, but in all, I would expect that our sales our pounds certainly won't be as negative as they were. They may be positive. We'll wait and see, but I think it'll be much more competitive on that front. But for sure, we'll see some pricing because we still see inflation in the marketplace.
Yeah. And Andrew, this is Kofi. The only other thing I would add is just given the comps, we would expect a little bit more weighting to the front half on the growth profile versus the back half.
Got it. And then just super quick follow-up to the inventory piece, just to put a sort of point on that. With supply chain constraints easing and obviously General Mills looking to get back to, much more active merchandising and display activity and all of that, I guess I would have thought that retailer inventory reductions would be sort of counter, to that dynamic, right? Wanting to get out there collectively and collaboratively and get going on merchandising and really driving volume and whatnot. I guess, what am I missing on that thought process? Is it just that retailers are so much more confident now that they can get what they need when they need it from you and others, that the safety stock that was more aggressive just isn't needed? Or because I would think, if it's the first time in a couple of years that you can get out and really drive the business, everyone would be, I don't know, maybe it's naive, but okay with a little more inventory just to make sure you have it on hand.
Yeah, Andrew, this is John. I think it's a fair question for sure. I've had a chance to check in with a couple of our major retailers, and again, I think everyone's just trying to figure out the way forward. And I think for the immediate term, and if you think about some of our big retailers, not only carry food, but they carry general merchandise, there's been a big focus on just making sure they get inventories in check. And they feel like when they're in check, they can then drive the business moving forward. So I think they were definitely holding a bit more stock because even up until 6 months ago, we had supply disruptions throughout many of our categories. When they feel better about the supply, they felt like they could bring it down a bit. As we move forward, again, I think as we get the bottom line, the volume moving and really get back to merchandising, we would expect retailers to certainly support that and bring it in. Again, I just think it was a point in time and not something that we're reading into the future. And again, as I talk to these retailers, I don't think that they plan to bring them down in the future. And to the extent we can drive the top line, they'll continue to invest behind inventory as well.
Great. Thanks so much.
Thank you. Our next question is from the line of Cody Ross with UBS. Please go ahead. Your line is now open.
Hi, this is Brandon Cohen filling in for Cody Ross. Thank you for taking our questions. So you mentioned in the prepared remarks that with your current debt levels, you have more flexibility for M&A going forward. What categories are you targeting, and what are the main characteristics that you're looking for in an acquisition target? Thank you.
So So it is true. Our balance sheet is in great shape thanks to the profitability we've had for the last few years, as well as all the work we've done on payables and receivables and such. So our balance sheet is in really good shape. We do have a lot of flexibility. The first point I would say that even though we have a lot of flexibility, we're still going to remain disciplined. To the extent we look at M&A, we have about 50 basis points of growth we'd like to get from M&A over the coming years, both through acquisitions and divestitures. And so in general, we'll look for businesses that are accretive to our growth and in categories we're already in, or adjacent to categories we already participate where we think we have a competitive advantage. And to the extent we do those things and they're bolt-on acquisitions, we would expect some synergies to come with that growth. And so I'm not going to get into a specific category that we're looking at. You can probably guess them as well as anyone else, but they would be growth. But I can say they'll be growth oriented, and they'll be places where we think we have competitive advantage and we can create value for shareholders.
Great. Thank you very much.
Mm-hmm.
Thank you. Our next question is from the line of Pamela Kaufman with Morgan Stanley. Please go ahead. Your line is now open.
Hi, good morning.
Good morning.
Your gross margin was a highlight in the quarter. Just wanted to get a sense for how you're thinking about gross margins in fiscal 24. And then for the 5% input cost inflation outlook, I guess could you just give us a sense for how you're thinking about the cadence and how that influences the cadence of your gross margin for the year?
Well, Pamela, first of all, thank you for asking about that. Gross margin was a highlight for the quarter, and it was a highlight for a year, and I think it'll be a highlight in the coming year as well. And we're really proud of what we've been able to do on the gross margin front over the last couple of years. And so probably turn it over to Kofi with more specifics, but appreciate the question.
Yeah, and I would just add, I think we've made some really good progress in moving back towards our pre-pandemic gross margin. We still have a little bit of work to do. And obviously, if you read our guidance, you can expect that we expect to make further progress towards recovering our gross margin levels. I think the important thing to note in our guidance around inflation is that we see it moderating, but there will still be inflation above sort of the historic levels we would expect to see in our category. And as we work through the year, I wouldn't necessarily call out anything notable as you expect the quarterly flow to play out, other than the comments I made about sales and the expectation of the price mix and SRM actions and the interaction of those on the top line. I think the key thing for us, though, is that we do see a step up in our HMM levels. At 4%, a 1-point step up from the past couple of years where we've been kind of under-delivered at 3%. With the moderation of supply chain, that we certainly have higher confidence in being able to pull that off, as well as our confidence in our ability to take out some of the significant levels of costs and continue to take out some of the significant levels of operating costs that we put into our business model to manage through service disruptions. So all of those things give us a confidence that we should be able to continue to drive back towards that pre-pandemic level of gross margin.
Thanks. And my second question is just around the promotional environment and your outlook for promotions and brand building. How are you thinking about reinvestment levels in fiscal 24? And any color on the mix between price promotions versus marketing and advertising? Thanks.
Yeah, I would say as we look ahead to our marketing and the promotion environment, the first thing I would say is really important to remember that we still have inflation. I mean, there have been a lot of a lot of commentary about, disinflation or going negative, but we don't actually see that. And it's driven by labor costs inflating. And so I think that's the first and most important thing to remember as it relates to the promotion environment. We would expect that promotional frequency would increase a little bit, and importantly, that the quality of our merchandising, especially display merchandising, will improve. And the reason we think that will improve is that retailers have more confidence that we'll be able to supply the business because our service levels are back in the 90s. And when that happens, they're more confident in displaying. Display merchandising for us, has very high returns. And it does for our retailer as well. So we're kind of aligned in wanting to do that. And now we feel as if we can. And so as I look ahead, I'm not sure the promotion intensity is really going to increase that much. I think it's going to be maybe a little bit of frequency and actually more quality, if you will, merchandising levels. As it relates to marketing, we really like our marketing across our biggest categories, and that's why we've been investing in it, and we'll continue to invest in it. I'm not going to lay out a number. Our marketing will improve X%, but what we have said is long term, our marketing spend will grow, in line with our sales growth. And over the past few years, our marketing is actually up 35% versus pre-pandemic levels. So we've actually done that, which will benefit us in this year ahead, because what I can tell you is that, consumers in this environment and customers, they're all looking for new ideas and ways, and our customers are looking for ways to grow. And so we feel good about our marketing spend in the year ahead.
Thank you.
Thank you. Our next question is from the line of David Palmer with Evercore ISI. Please go ahead. Your line is open now.
Thanks. Good morning. As you were setting your guidance for fiscal 24, what were the biggest challenges to visibility or variables that you're thinking about for this year? Is it simply North America retail consumer demand or other factors?
Yeah, that's certainly the state of the consumer, the interaction of frankly all the interest rate environment and the expectation of a potential economic slowdown on consumer behavior is certainly a variable that's very front and center for us as we set the guidance. Obviously inflation remains at least sticky and above expectations. And I think that the challenge of setting expectations in this environment that, any one of those and visibility into any one of those factors is hard enough. The interaction is what gives us sort of the challenge of setting the frame for the year. But we're confident that kind of whatever operating environment actually shows up, that we will be able to respond and pivot as needed.
Yeah, I wonder how you were thinking about that North America consumer demand, given the industry has been slowing on a multi-year basis right through the last month or so, and I'm just wondering if you're assuming that recent rate. I mean, we hesitate to use 4-week data to project anything else, but I also hesitate to use even 12-week when the multi-year's been breaking down for the industry. So I'm wondering how you assume that multi-year trend and how you think about that demand in 24, given the slowing in the industry and the consumer lately.
No, I think that's very fair, David, and I can understand your angst on this point. I guess I would do a couple things when we talk about 3-week data. Last time I remember talking about 3-week data was back in December, when there was a panic about what was going to happen due to timing of Christmas and New Year and Nielsen data, and then it turned out that it wasn't as bad as people thought. So I think that's a cautionary tale about 3-week data. The other thing I would say is that if you look at 2-year comparisons over the last few weeks, what you'll see is that over the last couple of years the trends haven't changed all that much. Having said that, I mean, as you look at the last 12 weeks, it's pretty clear that volume elasticities have increased, and it's something that we expected and we baked into our guidance for the year. And so elasticities have not been zero, but they've been quite low. We would anticipate as the year goes on that elasticities will increase, and that's what we have seen. And so I want you to know we're not too surprised by the last quarter's trend, and it's anticipated in our guidance. And so that's what. But look, it's a hard period to to model from that perspective, but that's what we think is going to happen, is that, well, elasticities will increase, but that's accounted for in our guidance already. And the last 3-week trends, I wouldn't follow those all the way out the window.
Got it. Thank you.
Thank you. Our next question is from the line of Max Gumport with BNP Paribas. Please go ahead. Your line is now open.
Hey, thanks for the question. It's nice to see the recovery in dry pet food and treats. However, it does sound like the trends in wet pet food have been a bit challenged. From what I understand, it seems like maybe it's a mix of your own service levels as well as some category weakness as a result of changes in the consumer economic environment and consumer behavior as well. So hoping you could talk a bit about what you're seeing in that subsegment and what you expect in terms of a recovery moving forward. Thanks.
Yeah, Max. Well, Max, I think you just summarized it. You summarized it nicely. What we see there are a couple of different trends, and remember, the pet category is almost a $50 billion category, so there can be lots of trends going on at the same time. Importantly, there's still a trend toward humanization, which is why I think you see our dry pet food recovering so nicely, and why you see our treats business recovering. At the same time, people are more mobile. And so they're not, in aggregate, the treat segment is down a little bit and the wet segment is down a little bit because consumers are not home as much, and so they can't dote on their pets as much as when they were home all the time. On top of that, as consumers are feeling the pinch from inflation, there is some downward pressure in several of the places on sales, and I think you see that most pronounced in wet foods, a little bit in treat. It's a tailwind for our dry pet food business, and so that's one of the reasons why we see that improving. And so, but I think in general you have the plot, which is that our wet pet food business has not recovered as fast as we thought. Part of it is due to mobility, part of it is due to service, and part of it is due to behavior in the current environment.
Great, appreciate it. And one follow-up would be on volume for fiscal 24. You gave 3 reasons to believe we could see some improvement, at least in the rate of decline. And we've touched on 2 of them on the call, but I was hoping to move to the capacity side regarding the constrained platforms, so pet, hot snacks, and fruit snacks. Any way you can help us get a sense for the increase in pounds that you might expect in fiscal 24 on those platforms? Thanks.
Yeah, so you're right, Max. Those 4 platforms, we do have significant capital investment coming online. The first 3, exclusive of pet, we would expect to see some of that capacity impact this fiscal year. The pet capacity comes online really pretty late in the year, so it would have a very modest impact on our ability to internalize some of the supply for dry dog food.
And Max, I would just say beyond capacity, supply disruptions are probably the biggest tailwind for us. Last year at this time, we had significant issues on things like yogurt and bars. This year, we're feeling much better about the way we're performing. So at least for North America retail, we feel really good that we'll be able to supply all of our businesses and merchandise behind them for the first time in several years, which we feel great about.
Max, maybe this is Jeff Seaman. I'd add one on pet. Kofi is exactly right that our internal capacity comes online in about a year, but we did add some external capacity in the last couple of quarters. So that will give us an opportunity to, and it has already given us an opportunity to improve service, both on our treats business as well as on our dry business.
Great, thanks very much. I'll leave it there.
Mm-hmm.
Thank you. Our next question is from the line of Matthew Smith with Stifel. Please go ahead. Your line is now open.
Hi, good morning. I wanted to ask a follow-up question on the pet business. The profit recovery there is underway, and there's been some commentary that you expect operating profit to grow a bit faster than organic sales in fiscal 24. Can you provide some color on the puts and takes for the margin recovery after a couple of years where we've seen the margin compress? I know you have incremental capacity coming online. It sounds like that's later in the year for external supply chain costs are lower across the organization, and you have some pricing there. So what are the offsets benefiting or limiting that margin expansion in 24?
I would say on the benefit side to margin expansion, we have some pricing that we have already taken that kind of wraps around in the current year, and you see that in the current results. You certainly saw that in the fourth quarter. You'll also see our productivity levels in pet are good, and the fact that our supply chain is not disrupted also helps bring down costs. And so all of those things go to the gross margin level. Kind of what partially offsets that is the fact that we have external manufacturing and not our own internal manufacturing, and so the benefits of some of that will not be as great as they would have been otherwise. I would also say that we're really as much as we are focused on profit recovery on pet, we really want to drive growth. And so, we will invest in marketing and capabilities to make sure that we accelerate our top line growth on pet. And so we may see a little bit more gross margin expansion than we do operating margin expansion. And that's simply because as we get healthier on supply chain, we'll reinvest some of those savings back into driving top line growth on pet.
The only other thing I would add is just there might be a modest mix of business headwind from production of just a little bit less wet, obviously, given the macro trends that Jeff referenced. And so as you take that into account, that would be a put.
Thank you. I can leave it there and pass it on.
Thank you. Our next question is from the line of Brian Spillane with Bank of America. Please go ahead. Your line is open.
Hey, thanks, operator. Good morning, everyone. Kofi, I just had two questions related to the cash flow outlook for 24. The first one is just, free cash conversion back to 95 versus 80. Is that mostly just working capital that'll drive that improvement?
Yep, that is the primary driver, and that was also the primary driver of the miss that we had this year relative to our long-term target. So challenge, obviously, of the other side of the inventory reduction in the retail trade was unexpected inventory build as we went into the last few weeks of the year. So as we step into next year, supply chain environment's more stable, gives us the capacity and the ability, frankly, to have more visibility and manage our inventory levels lower. We continue to make progress on our overall core working capital in our pet business, so those things should help us drive a more significant provision of cash from working capital next year.
Okay, so the bulk of it is inventory, right? Is that kind of the way to look at it, the majority of the improvement?
Yeah, year over year on a cash flow basis, that is a fair way to look at it.
Okay. And then the second one is just, I know you've given the interest expense guidance, and you called out having refinanced some debt at a higher rate. Kofi, is there any opportunity with some of the shorter term, whether it's commercial paper or, just shorter term debt, is there any possibility to just apply some free cash flow to kind of take down some of that short term debt in order to kind of relieve a little bit more of the interest expense pressure?
Yeah, we do expect to be able to run with lower commercial paper balances, but I mean, candidly, commercial paper rates and long-term debt rates at least in the middle of the curve were somewhat inverted for periods of time as we looked at the tier 2 market in which we issue commercial paper. So we actually could issue term debt more cheaply and did that here as we came out of the fourth quarter.
Okay. But so it doesn't sound like there's a lot that you can do to chip away at that sort of.
Not an immediate arbitrage. I expect, look, this will be an adjustment factor as we see some of our term debt roll off. As long as we're in this higher interest rate environment, that will be a modest headwind. It is manageable, and we happen to have a fair amount of maturity concentration in this call it 2 to 3 quarter window which is driving our outlook for next year.
Okay. All right. Thanks, Kofi. Thanks, guys.
You bet.
Thank you. Our next question is from the line of Chris Carey with Wells Fargo. Please go ahead. Your line is open.
Hi, good morning. So just a couple quick follow-ups for me. So just number one, do you think that, inventory availability is, impacting consumption that we can see in data at all, right? So on-shelf availability, is that becoming a factor with these inventory cuts, or is it reasonable to assume that what we see coming through is, kind of pure consumption? The second question would be just around, kind of a follow-up around pricing for fiscal 24. The press release said that most of the pricing in fiscal 24 would be carryover. Obviously inflation will still be quite a bit above historical norms. So are you embedding any yet taken pricing into the fiscal 24 outlook? It's just, overall thoughts on, the potential to take incremental pricing, not already in market. So thanks for those two.
Yeah, so on the first question, on-shelf availability is significantly higher today than it was a year ago across most of our categories. So again, everyone's gotten better. I think the supply situation has become more stable. So as a result, retailers feel like they don't have to hold as much inventory to service the demand. The other thing I would tell you, as we've invested in digital capabilities, so have retailers. I can tell you their inventory systems are much more sophisticated today than they were a few years ago. So obviously their goal is to keep the shelves full, but at the same time hold as little inventory as possible. At this point, we don't see inventory as a hindrance to us being on the shelf or getting the displays when we want them. Again, I think they're just focusing on their working capital and trying to manage it as efficiently as they can.
Yeah, and when it comes to pricing, we're not going to comment specifically on forward-looking pricing. Having said that, we did say that the majority is in the marketplace already. That is true. We operate in markets all over the world, some with different inflationary pressures than others. So it's not really just about the U.S. But we feel good about what we see right now with our pricing and the inflationary environment that we see. But we all know these things can change over time, and so we think we have most of what we need in the marketplace already. But there may be a category or two we need a little bit more. There may be a geography or two where we need a little bit more because the inflationary prices are different.
Okay, thanks. One quick one, just and then I'll be done. But yeah, Jeff, you've been talking for a number of quarters now about promotional levels and how promotions would remain rational, and you've listed kind of a number of reasons why. I just wonder, with supply chains coming back, and you've already commented it on the call today, but how do you think about the tools that you would have to reignite volume growth? So say obviously there's a concern about some normalizing of volume. Like what are the kind of arrows in the quiver, I guess, right? Is it more promotion? Is it more advertising? Is it more merchandising? Can you just talk through maybe how you think about, potentially lifting volumes over the next 12 months if we see any shifts in the consumer environment? Thanks so much.
Yeah, sure. As I look at it, first of all, the promotional environment has been quite rational, and I suspect that it will be going forward. I haven't seen anything yet to lead me to believe otherwise. As we look at what's going to drive growth, I think it'll be a number of factors. One I would lead with is new product innovation. Even though our new product innovation has led our categories each of the last 4 years, it's still below what we would have expected normally. And the reason is not because we haven't had good innovation. It's because some retailers were reluctant to bring it in because their own supply chains were pressured, our own supply chains were pressured. And so as I look at the year ahead, I like our new product innovation that we have to come. But I also think we're going to get better distribution on innovation we've had over the last couple of years, where we didn't get full distribution, even though it may have warranted, given the quality of the innovation that we've had. And so I think that will be a driver. The same with distribution. And I look to our pet business, especially on our distribution levels of treats and wet, because we haven't been able to supply the business. And so if you can't supply the business, that means that you're going to lack some distribution. You may have some distribution gaps. And so distribution growth across a couple of our key categories in North America retail, as well as pet, is certainly going to be an opportunity for us. And then with promotional spending, I think it's going to be the quality of our merchandising. And, we have very good tools to understand what the return on investment are. So do our retailers. And so I don't know that it's going to be a significant increase in the amount of merchandising. I think it's going to be, I would hope, and I would certainly anticipate, an increase in the quality of the merchandising, which should be good growth drivers for our retail customers as well as for us. And because in our categories, they are really expandable consumption categories, and the more you have in your pantry, the more you tend to use. And so those are some things that I think will be the drivers, along with increased marketing. And our marketing has been very good, and we have a lot of tools to ascertain where the best marketing spend is going to be. And we've been investing in our brands. We'll continue to invest in our brands. That will certainly be a source of growth for us.
Okay. Thanks so much for the perspective. Appreciate it.
Okay, Malika, I think we'll wrap up the questions there. Maybe I'll turn it to Jeff for some closing comments before we finish the call.
So I guess I'll end this call where we started, which is to say, as we take a quick step back, we're really pleased with the year that's just happened, and 10% sales growth, 8% operating profit growth. That excludes a 3% headwind from divestitures, as well as earnings per share growth that are double digits. As we look forward, our guidance is to be in line or exceeding our long-term growth algorithms on sales, operating profit, EPS, and certainly on dividend increases. And so we are confident about the year ahead, and that confidence is driven by our ability to navigate a number of environments these past 3 years. And will this next year look different from the last? Of course it will. But we know that already, and we're confident that we have a team and brands and capabilities that'll thrive in the year ahead. And so we look forward to keeping the conversation going.
All right, I think we'll wrap it there. Thanks everyone for the time and attention, and we're available throughout the day for follow-ups, and we look forward to connecting again later on this year.